What's up everyone? So in this video I thought I'll go over a trade kind of breakdown, but more so planning my session, right? So I get a lot of questions about why do you enter here, why do you enter there? The truth is it all comes from planning the session before the session even starts. So having a routine is very important, but having a routine in trading is non-negotiable, meaning you need to have it. So for example, if you're trading the New York session, let's say you're trading the New York AM session. If you're trading the New York AM session, this is going to be from 9:30 AM to at the very latest 11:30. However, I'm usually done by 11 Eastern. Now, with that being said, you need to plan your session. So if you're planning a session should come anywhere between 9 to about, I would say, 9:25. Definitely before 9:30, right? Because the market opens at 9:30. So if you don't plan a session, the chance of you being successful is precisely zero in the long term, right? So this is the difference between kind of trading and gambling, right? So having a plan will stop you from overtrading, revenge trading, hesitating. If you can come to the charts and you know exactly which key levels to look for, which areas to avoid, what's going to get swept, what's going to get hit, what's going to break. If you know these things, if you know where you're positioned in terms of the weekly and daily opening price, all these things will help you with execution. So execution doesn't come from having the best strategy necessarily. It comes from having a strategy, but you don't need the best strategy. What you need is to be planned beforehand. So a lot of people don't know how to execute. Then they blame their psychology. When in reality, execution comes down to buyers and sellers. Taking good trades and overtrading and revenge trading can be eliminated if you simply spent 15 minutes before the session planning the session. It's that simple. So what do I do between 9 and 9:25 Eastern every day? So there's a 4-step process that I follow. The first is market structure. Now these are highs and lows. One of the most diluted and underrated topics in trading is the concept of market structure. And so market structure itself is very simple, right? So this is a structure high, this is a structure low, this is a structure high, this is a structure low, and then this is my structure high. All right, that took about a minute to do, and it's not that difficult. So every time you see a structure break, just draw an arrow like this. So the rules I have with market structure, because I know a lot of people get market structure wrong. Market structure has two main roles, right? Every time you see a move up, you want to see a sharp move down. So what I mean by that, you want to see sharp move down, sharp move up, sharp move down, sharp move up, sharp move down. And so the reason I'm sharing this is because when I see price doing, if I see price in a range, kind of trapped in a range like this, I'm not going to start marking out every single little high and low like this. I'm not going to do that. This is incorrect. What you really want is to mark out those sharp highs and lows, right? So this is what I have over here. This is what I'm looking for with market structure. I want to see sharp highs and lows. Market structure does take a bit of practice to understand, but it's one of the simplest concepts when you get it, and it's very easy to transform your trading if you simply knew where structure was. And the reason why is because that leads on to step 2, which is the idea of premium and discount. But before we get there, you need to know what the dealing range is. So the dealing range is what I use to separate out structure from PD arrays. So PD arrays is premium and discount. Now a dealing range, the reason I put this in is because I see a lot of traders getting kind of getting over confused as to which levels to trade from. So you only want to be trading levels that are inside of your dealing range. So if you're not inside of your dealing range, there's no point trading those levels. So a dealing range, simply put, is the most recent low and the most recent high. Just like this. It's the most recent low and the most recent high. That is it. Now after dealing range, step 3 is PD arrays, or premium and discount. I'll just write PD arrays for sure. Now a PD array or premium and discount simply means buying low and selling high. So the way we translate that is by understanding our market structure, understanding the dealing range, and then projecting the fib or the Fibonacci from the swing low to the swing high, just like this, low to high. And now from here, it's very obvious whether you're in premium or discount. So I'm going to break down today's trade as well. So for example, this is super easy. That this is the EQ, this is the premium, and this is the discount. So you want to be selling from premium to discount, and then from discount back up to premium if we get the confirmation here. So using PD arrays is important, but you have to combine it with market structure and dealing range. So you need to have 1, 2, 3, and then last but not least, we look at fair value gaps. So fair value gaps is step 4. So a fair value gap is one of the most overused concepts and one of the most underrated tools in trading. So how was I looking at this? So yes, we had a choppy session. but we want to look for the last 15-minute fair value gap prior to market open. So prior to market open, which was around, this is obviously here, so when we go from blue to white, the 15-minute fair value gap you want to look to trade from is this one. So this here is the fair value gap. I'm going to label that in blue. So for those who don't know how I use fair value gaps, I use fair value gap to derive my key levels. So now we've been through the 4-pillar approach. So the 4-pillar approach we've been through, so it's these 4 things: market structure, dealing range, PD arrays, fair value gaps, right? So market structure, dealing range, PD arrays, and now we found our fair value gaps. Yes, we have a fair value gap down here, or we have a region, we have a section of fair value gaps resting here, but these are significantly below, so I'm not necessarily waiting for price to come there. I'm looking to see what we have here. And so this is basically the fair value gap we're dealing with in premium. So how do we derive our key levels from here? So for those who've been following my content, you know that I use the candle, one candle before the fair value gap. Now, it doesn't matter whether that candle is black, white, green, purple, wick, no wick, doji, how much, doesn't matter. All it matters is you're looking for the candle before the fair value gap. This tells you where you are trading from. So this is your key level. Now, once you have a key level, I mark this out in gray. Once you have a key level, trading becomes a lot simpler, way simpler, because now you know where to trade from. Now, ideally, if you look at this key level, what makes a key level, or what makes an A+ key level is, number 1, it's in the premium. Number 2, it's left a 15-minute fair value gap. And number 3, we're going to use the weekly opening price or the weekly PO3. Weekly PO3. So how do we use that to our advantage? So here we have the weekly PO3. So this is the weekly candle. Now, for those who don't understand how the weekly candle works, or any higher time frame candle, the candle will open, we will manipulate lower, and then we will head higher. Now, when you're above the weekly opening price, so let's say we have this is our key level, I'm just going to drag it over. The way that a weekly candle forms is it will manipulate both buyers and sellers in the market, meaning if you want to sell, you want to position yourself at a higher price. Selling must be done high and buying must be done low. Now, this is a very simple concept to understand because it extends way past trading, right? You want to be buying things that are cheap and selling them when they're high. We just translate that same basic human logic, economic knowledge, whatever, economic common sense to the markets. So this is our equilibrium, this line over here. This is our weekly opening price. Just going to label this. This is the WOP, or the weekly opening price. So we want to be selling above the weekly opening price. Yes, we look for confirmation here, but I just want to go over how I plan my sessions, because this is all about planning the sessions. When I plan my sessions, I typically look for a key level or multiple key levels, usually only 1 or 2, that align with some A+ criteria. So the first of those is, yes, I look for it to be in premium or discount. I definitely want to see a 50-minute fair value gap, and I'm always interested to see where is that key level with respect to the weekly opening price. So this is obviously way above. Whereas if you looked at Monday's key level, we were actually a bit below. So this shows you want to be buying below the weekly opening price. This shows you want to be selling above the weekly opening price. So this is a couple of things I use to plan my sessions. In terms of the actual trading, you're simply looking for a break and retest. So if you go down to the 5-minute, we had a break and retest over here. So it's not a coincidence that we sold off from here. So if we sell off here, stop loss above the key level, it's not a coincidence that we're now kind of heading lower to the EQ, right? So the reason we're doing that is very simple. We're looking to sell from premium to discount. We're just going in this order. This is the weekly opening price. It's not a coincidence we've done this. Again, if we just go up to the 15-minute time frame, what am I talking about with premium and discount? So premium and discount, very simple, is this concept. So what we had here, we had a high, we had a low, we had a high like this. So if this is your low, this is your high, this is your structural dealing range, this is your dealing range like this. And so this is a premium, this is a discount. You want to sell from premium back down to discount. It's that simple. It's not anything, it's not rocket science. It's just about, I guess, being patient and waiting for the setup to come to you. Now, if you just get rid of all the drawings, for example, the one thing that can keep you on the right side of the market for holding trades is this line here. This is the weekly opening price. And so the weekly opening price is the most powerful thing you can use. Fair value gaps below the weekly opening price, you want to be buying from. So for example, here's a key level from Monday, the 22nd of September. Again, depending on how you could have traded this was your first key level here, and this was a key level from the 23rd of September. So this was here. Now, what is special about these two key levels, right? So if you look at these two key levels carefully, why did this one give a good buy? Why did this one give a good sell? So this red line here is the weekly opening price. And so you want to be selling above the weekly opening price and buying below the weekly opening price, right? This is how a weekly candle forms. This is what power of three means, right? So power of three on a weekly perspective means the market will open on the week. Manipulations will occur here. So a manipulation simply means you want to be buying below the weekly opening price. A manipulation occurs to take people in the opposite direction. The markets will move lower to then move higher, right? And the markets will move higher to then move lower. So this is just, so I know I was going to say psychology doesn't matter. I'm going to explain to traders why psychology doesn't matter, right? It's crazy how so many traders blame psychology without having a strategy, right? So going to go over a trade I took on Tuesday, the 23rd of September. So this trade, I'm just going to open Discord quickly. So this trade is something I planned before the market even opened, right? So when I came to this, I'm seeing this, right? This is a key level that I had. Oops, sorry about that. So this is a key level that I had. Again, quickly, what makes this key level valid is the fact that, okay, it's left a fair value gap, right? It's above the weekly opening price. Above the weekly opening price, right? Notice how we've had a two-phase manipulation model. And so what do I mean by a two-phase manipulation model? So my entry was here, but when we had entered the market, what you want to understand is we had taken out the Asian high, right? So this is the manipulation to one side, but also we had taken out the Asian low, right, when we formed this key level. So we had a lot of confirmation to go short. So the reason I'm saying psychology doesn't matter is that once you stack the odds in your favor, if you can't execute, it's because you haven't stacked the odds in your favor. It's not because you have a psychology problem, it's because you have a knowledge gap. So I don't want to go on a tangent on this, but a knowledge gap can be fixed with lower ego. So knowledge and ego go oppositely hand in hand, right? So ego is the biggest thing that stops traders from being successful. Knowledge is the fastest thing that stops traders from being successful. And so knowledge and ego go hand in hand with experience, because experience isn't always a good thing. Because if you've been practicing the wrong thing over and over and over again, you built up through incorrect knowledge a lot of ego and into thinking that your psychology is stopping you from being profitable. No, your psychology isn't stopping you from being profitable, right? Psychology comes in with sizing over time, right? A lot of people aren't there because they simply don't have key levels. They don't know where to buy and sell from, and they don't truly understand why the markets move up and down in the first place. It's not patterns. It's not even liquidity sweeps. These are all confluences, right? But when I ask traders what's their strategy, what's their confirmation, they don't have it. They don't have it, right? So this is the problem. It's not a psychology problem, right? It's an ego problem, right? I'm saying ego not to offend people, but it's an ego problem because until you can fix the fact that you don't know where to buy and sell from, it's very difficult to blame anything other than your ego or lack of knowledge, right? The reason I say ego is because a lot of people think they have a strategy, but they don't. Right? If you say, okay, I don't have a strategy, I need to develop and learn a strategy before I can then start blaming psychology, that would not be ego, right? That would be self-awareness. But for those who think they have a strategy and they blame their psychology or their patience or their emotions or anything like this, when they don't know they don't know why they're buying or selling, then that is an ego problem, right? So ego will slow down your progress massively. So if we look at this trade, I think I was trading it on the 5-minute, right? So this was a 5-minute setup, quite a slow trade, but it did play out. So how was I planning this position, right? So when I trade my levels, I'm looking to simply look for a break and retest at my levels, right? So I'm just going to play price on. So just go back on the Discord. So when I plan my levels are 15-minute fair value gap. So here we have so this was posted on the S&P 500, one of the levels I'm watching, but I was reluctant to take it because of how rangy the market was, right? I want to see price take out the previous day high, which we did actually. We took out the previous day high eventually, then we sold off into here, right? So I already knew I wanted to sell from this level. So this was 1446, so 9:45 Eastern in New York time, right? So now that we've come into this level, so again, this was at 10:25 Eastern. Why did I take this short, right? So I was short at around, I think it was 11:30 Eastern, or sorry, quarter past 11 EST. I got in short roughly in this area, right? So this is where I got in short. So I got in short with 11 contracts on MES down to about here. So 67.43 was my entry. So we're going to be breaking down why psychology is overrated. So I want you to look very carefully at this image, and I want you to ask yourself, do you know why the market moves up and down? Do you know why the market moves up and down, right? Without even looking at this, right? So I'm just going to move this away for 1 second because I've kind of given you the answer to my question. Do you know why you could have taken a sell, right? So it is a break and retest at a key level, but do you fundamentally understand why this level held to the downside, right? Why did we see this and not this? So what was going on here? So there is nothing that this chart will tell you. You need to know what was going on in places like this, and you need to know especially what was going on in places like this. So we're going to really break this down in terms of order flow. Specifically, if we just take a look at this, so here is here. So what you see here is, without even reading too many of the numbers, you see a lot of aggressive buyers. You see that via blue delta. Blue delta simply means that there's more aggressive buyers than aggressive sellers hitting the ask. So the right number is the ask. So when the right number is a lot bigger than the left number, we had a lot of aggressive buyers. So what you want to understand here was this region specifically. So if I just draw it out, this region specifically, we had a lot of buyers, right? Buyers, a lot of buyers. Now the question is, were they rewarded? Were these buyers here and here rewarded? Well, not really, because we melted, right? So this is what I'm looking for. So notice how we've just dipped below this level. So this red line is going to be important. We've dipped below the level, which tells you that these buyers were obviously not successful. So if you're trading, right, and you're out here blaming your psychology, right? Blame the fact that you're not reading price action for what it is, which is a big thing, right? So at this point, you can either say, I have a strategy that works, or you can admit to the fact that you have ego. You've got two choices from here, but you've got to understand fundamentally what you're doing, right? So when you see a lot of buyers here, if these buyers are not successful, so what we call is they had no follow through. So you're looking for follow through. Now, if you don't have follow through in your order flow, if the order flow is telling you there's no follow through, what that means is that the opposite players are in control. So buyers are aggressive, but sellers are in control. So what we mean is they're sell limit orders, right? So we call these limit orders, or you may have heard me call them passive sellers, right? So passive sellers, right? We see passive sellers just over here. And this is the sequence that you want to be going through every single time. So you want to have a key level, right? You want to see buyers failing with no follow through, which means sellers are in control. So they break below the level here. Now, to further confirm that, we're going to look at the retest. So we see price break and a retest. So we had 1, 2, 3 candles before we broke to the downside. So looking at this again, if I make the screen a bit bigger, so this blue box is what we're going to be focusing on. So can you see where it says 267 for 766? So there's a lot of aggressive buyers here, a ton of aggressive buyers here. So here, and also as we were selling off, we had some aggressive buyers here. But let me ask you a question. If you see aggressive buyers hitting the ask, they need to be breaking above the zone. So we see here price breaking below the zone once and twice. So you could have entered. So my entry came just below the zone. So this was 67.43. right? Stop loss just above 67.49, 48.49 area. So the reason the market sold off is not because of an EMA, an indicator, a fair value gap, a macro, an I fair value gap, an order block, a breaker block, the 2022 model. It didn't sell off because of any of those reasons, right? It sold off because aggressive buyers hit the ask. They failed to break above the level. So this showed me sellers were in control at this level. This level was predefined before the market even opened, or 15 minutes into the market. Now, with that being said, I hope you can understand why psychology isn't so important, right? So if you can't execute, it's probably because you lack experience in understanding what to look for. So we simply short from one key level down to the next, roughly this region, right? So we short from this key level down to the next key level, but as you can see, we really had a heavy melt off. So just to sum things up, right? So this is the XXX model. The XXX model requires three things. So I'm just going to write this down. The XXX model has three things. You need to know where to trade from. So you need to have a key level. You then need to know what to look for, right? So buyers and sellers. And then you need to know why you're looking for it. And the why is this chart. So knowing why the markets move up and down is very important, and you need to focus on that before you start focusing on psychology.